You know, every great idea needs a spark to get going. And let's be real, that spark is usually cash. But what happens when the traditional money sources just slam the door on new innovative companies? Well, today we're going to dive into a pretty radical idea that's shaking up the startup world by mixing ancient financial principles with brand new tech. So, to get why this is such a big deal, we got to look at Indonesia. Just look at this chart. In only 3 years, the fintech market there just exploded. It went from about $3 million to almost $40 million. I mean, that's not just growth, that is a full-on boom. It's a real hotbed of innovation. But with all that growth, with all that money flying around, you have to ask a really important question. Who isn't getting a slice of that pie? In this digital gold rush, who's being left in the dust? And that question brings us right to the heart of the problem we're talking about today, the startup funding gap. This is like a giant chasm that so many brilliant ideas fall into, way before they ever get a chance to take off. So, when we use the word startup, what do we actually mean? Well, the source material gives us a pretty clear definition. We're talking about businesses that are super young and super small. Less than 3 years old, fewer than 20 people on the payroll, and making less than 100 grand a year. These are the little guys, the nimble players trying to make a big splash in a world full of giants. So why is it so tough for them to get funded? Well, the usual doors are often locked shut. Banks, they want collateral, which these new companies just don't have. Venture capitalists, they want to see a solid cash flow, which, well, it's not there yet. And then there's this huge issue called information asymmetry. It's kind of like selling a used car, right? You know every little quirk and sound it makes, but the buyer just sees a shiny paint job. That knowledge gap, it creates a massive wall of mistrust for potential investors. So with all these roadblocks, entrepreneurs have to find another way. And this is where our story gets really, really interesting. Let's talk about the solution that this research proposes: Islamic crowdfunding. Okay, first, a quick reminder on what crowdfunding is. At its heart, it's a really simple idea. Instead of getting one massive check from a single bank, you get lots of tiny contributions from a whole crowd of people online. It totally cuts out the old-school middlemen and opens up funding to everyone. So, what makes Islamic crowdfunding so different? This slide lays it out perfectly. See, conventional crowdfunding will fund pretty much any business idea. But the Islamic model, it has two core rules. First, the business itself has to be halal, or permissible. But here's the real game changer. The way it gets funded has to follow specific ethical guidelines. It's not just about what you fund, it's about how you fund it. We're talking a complete ethical framework, from the ground up. Okay, so that's the theory. But how does this thing actually work in the real world? Let's break down the framework of the platform. Now, I know at first glance, this flowchart might look a little complicated, but it's really just a roadmap showing how everyone connects. It's a great illustration of how an idea gets from inside a startup founder's head to being a fully funded project. And don't worry, we're about to break this down step by step. So let's make that journey simple. It really comes down to 4 key steps. First, the startup sends in its project idea, and it gets a really tough screening. If it makes the cut, step 2, the platform launches a funding campaign. Next, investors can browse all these pre-approved projects and decide where to put their money. And finally, and this is so important, the platform and a special board keep an eye on everything to make sure the project stays on track, both financially and ethically. So who are the main characters in this whole story? Well, there are 4 essential groups. You've got the startup, obviously, the one with the big idea. You've got the investors, the people with the cash. Then there's the crowdfunding platform, which is kind of like the digital matchmaker. And unique to this whole model, you have the Sharia supervisory board, who acts as the ethical referee, making sure everyone plays by the rules. And that brings us to the real soul of this model, the thing that makes it totally different from any other kind of funding out there, the Sharia rulebook. Right, so here's the crucial point, and I really want to drive this home. It's not just about making sure you're not funding a forbidden industry. The actual mechanics of the investment, the contract itself, has to be ethical according to Islamic principles. This is a massive shift from the debt-based system most of us are used to. It's all about how the money actually works. So what does that actually look like? Well, instead of debt, the system uses these specific contracts that are all built on partnership. Take Mudaraba. Think of it like this. One person provides the money, the other provides the expertise. If it works, they share the profits. If it doesn't, they share the loss. Then you have Musharaka, which is a true joint venture where everybody puts skin in the game. All parties contribute capital, and they all share in the outcome, good or bad. The central idea here is shared risk and shared reward, which is a world away from a traditional loan where the lender gets paid no matter what happens to the business. And, to really get what's in, it helps to know what's strictly out. The biggest forbidden concept is riba, which is basically interest. I mean, just imagine a financial world with no interest on loans. That's the core principle. The idea is that money shouldn't just create more money by itself. It has to be tied to a real business activity and shared risk. Also off the table are contracts with way too much uncertainty, called gharar, and anything that's basically just speculation or gambling, known as maisir. Now, this all sounds pretty revolutionary, right? But we've got to be realistic here. This is a new model, and any innovation comes with risks. This is not some magic bullet, and the road ahead has some pretty serious bumps. The research actually points out 6 key risk areas, which you can see broken down right here. You've got the obvious technology risk. What if the website crashes during a big campaign? Then there's market risk. What if it turns out nobody wants the product? And you can't forget the human side of things, operational risks, and the huge challenge of making sure everyone is following all these complex Sharia rules. It's a real high-wire act. So how do you handle all that risk? The study is incredibly clear on this. It all comes down to a solid foundation of trust and, importantly, regulation. The researchers put it perfectly. The regulators are expected to make a strong legal framework. Without clear rules of the road and government support, this amazing new model just can't reach its full potential. It needs that solid ground to build on. And that leaves us with one last really fascinating question. We've seen a system that's designed to be more fair, to share risk, and to fund real-world businesses with a strong ethical backbone. So could this model, this blend of ancient principles and modern tech, do more than just help a few startups in Indonesia? Could it actually hold the key to a more ethical, more equitable financial future for all of us? The answer to that? Well, it could change everything.